In this lesson, we'll be going over through lesson 3.5 and liquidity ratios. These liquidity ratios are obviously done thanks to the final account, so you'll have these values given to you in the case study itself. Now, the first of these profitability and liquidity ratios is gross profit margin. This measures an organization's gross profit as a percentage of its sales revenue. It basically indicates how well a business manages its direct costs. Gross profit margin is done by doing gross profit over sales revenue, and then you times that by 100. In order to improve this gross profit margin, you must increase the sales revenue or reduce direct cost. The strategies used for this are promotional strategies, launching new products with greater profit margins, reducing prices to increase sales, or raise prices if the product is in high demand, and you can change manufacturer. Next up, you have profit margin. So profit margin measures a firm's overall profit as a percentage of its sales revenue. So this time, it's indicating how well a business manages its indirect costs. This is calculated by doing profit before interest divided by sales revenue times 100. And to improve this, you must reduce your expenses, which may be unnecessary. After that, we have return on capital employed. This measures a firm's efficiency and profitability in relation to its size or the amount of money being employed in the business. Capital employed is the funds used to run the business itself. This is non-current liabilities plus share capital plus retained earnings. And in order to get return on capital employed, you must do profit before interest and taxes divided by capital employed times all that by 100. To improve return on capital employed, a firm must improve profits and deplete as many liabilities as possible. After these ratios, we have other types of ratios which are called liquidity ratios. These examine the organization's ability to pay its short-term liabilities. The first of which is the current ratio. Now, this is used to calculate the ability to meet its short-term debts by calculating the value of liquid assets relative to its short-term liabilities. This is done by doing current assets over current liabilities. It's a very simple calculation, and then you make it a ratio to 1. So whatever value you get, you do that to 1. Accepted value of this is between 1.5 to 2. You really should be aiming to be between those two figures, and it can be improved by raising the current assets or obviously lowering liabilities. Asset test ratio, however, is the same thing, just without having to sell inventory. So it's essentially telling you about the most liquid, how liquid you really are, because inventory, yes, it's considered a current asset, but it's not really that liquid. And you get this asset test ratio by doing the current assets minus the stock divided by current liabilities. And the accepted value is 1-to-1 for this, because obviously, essentially, all the rest will be cash. And the use of these ratios is it allows the employees to gauge the possibility of a pay rise. Managers and directors can assess the financial health of the company and the possibility for bonuses, and trade creditors and financiers can obviously assess the risks. Whereas the limitations are that it only covers certain time periods, not present or future indicators, only the past. It doesn't account for external changes in the economy, and no universal method for accounts is hard to compare. Because some businesses might be window dressing. This means that they alter their final accounts and they might be putting fake values out there. As well as that, it's purely quantitative. You're not doing a qualitative analysis. You don't know whether a business is just growing and what the situation might actually be around it. That was all for Unit 5. just you do not need to remember the formulas. However, it is important to know how you come up with them, because that way you will actually remember them during an exam and you'll remember the uses of them during the exam.